ways to study a company based on their earnings call transcripts, their earnings presentations, press releases related to their earnings, and the financial statements that come out shortly after their earnings. In this video, I want to walk through other financial forms that companies send to the SEC and the EDGAR database that will be useful for you when you're tracking a company throughout the course of the year, so you're not just waiting on quarterly earnings. We'll start with Form 8K, which we already know because that's what the earnings press release and presentation will come in. 8Ks are current reports. They're meant to be filed whenever anything major and material happens at a company. That said, they're not always material or important to shareholders. Sometimes they only contain stuff like shareholder vote outcomes, which are almost never in doubt, or pricing for debt, which is interesting but not so important. There are times, though, when 8Ks can be really material, and when they come even though the company didn't publish a press release. A new share buyback announcement, or a dividend raise, or a CEO, or more likely a CFO or other C-level executive leaving or joining the company. These sort of not show-stopping events, but important events will come out in only an 8K. The company might also update its guidance for the next quarter, either positively or negatively, so that they don't have a surprise on the day of the earnings. These are needle-moving things. I often notice a stock of mine moving more than 3% in either direction. And if I can't find anything else, I go to an 8K to figure out what's going on. Why is the stock moving? Often the answer will be there. Sometimes you'll know an 8K should be coming on a certain event, and it'll be a trigger for you to then make an action on something. So either way, 8Ks can be a useful, vital part of your investment tracking and research, and are worth keeping your eye on. Company executives and directors of the board, commonly referred to as insiders, often hold shares in the companies they work for. We want this to be the case. We want them to be aligned with us. If they do well when shares go higher, they'll be motivated to do everything they can for those shares to go higher, which is good for us because we do well when shares go higher. Form 4s are the forms that these insiders file whenever they buy or sell shares in the companies they work for. Form 4s can be quite noisy. A lot of times they're being filed because the insider received options and then they had to sell a few shares to cover the taxes on those options. Or they have a set up automated selling plan so that they can diversify or so that they can buy a house or what have you. There's a saying that there are many reasons that an executive or an insider would sell shares, but only one reason they would buy shares, which is because they think the shares are worth more than they're buying them for. That's not quite true because everybody knows that saying, so insiders have a second reason, which is to buy shares to express confidence in the company so that shareholders will stick around. Sort of a self-fulfilling confidence loop. There are entire investing strategies built around tracking Form 4s. I don't find them that helpful, but in the extreme, Form 4s can be really useful to see. A huge buy, let's say 10% or more of an executive's position in the company, is a positive sign, and regular selling by a management team or a chief executive or anybody else can be a bad sign if it's really heavy and really high volume and they never hold on to shares. Also, in times of market turmoil, it's useful to see any insider buying or selling as a further signal of how bad it really is out there. In March 2023, there was the regional bank crisis in the US, and I noticed a few financial companies whose shares have been hit heavily where there was insider buying. That doesn't necessarily mean they make great buys or that it's going to work out in the long term. It does seem to tell me that the world's not going to end in the next couple of weeks, in all likelihood. So it can be a useful signal. It can trigger some actionable information, and it's worth following. 13G and 13D forms are filed by investors who own at least 5% of a given company. They have to file the forms within 10 days of reaching this threshold, so these are more timely than 13F forms, for example, which we've talked about before. And these can help us know who the major players are in a stock. 13G is less interesting. It's a passive form, meaning that the investor doesn't plan to make any changes at the company. For smaller companies, a 13G form can be impactful, but for most companies, A 13G form is just going to be from an ETF provider or other passive investment vehicle, and it won't really say anything to us as investors. 13D forms are active filings. They mean that the investor involved is going to take an activist position, meaning that they're going to be trying to advocate for change at the company. They're going to want the CEO to be fired or the board to be replaced, or for the company to put itself up for sale, or for it to do a bigger share buyback. Things like that, a real change in strategy in one form or the other. These are worth watching because you can learn a lot from these situations. They're some of the biggest firework moments on the market outside of earnings. Activist investors are entertaining, they're loud, they often share their strategy and their thinking about the company. So you get some analysis, you get a window into how professional investors think, and they often get what they want, or at least some of what they want. And so if you have a company and you see a 13D filing on it, you should be paying attention because there may be changes to come in the months ahead. If you don't own shares in a company with a 13D filing, it's still worth watching in case there's an opportunity, or just to learn what happens and understand market dynamics and how different people think about how a company should be run. The last form that we can discuss is the proxy form. The proxy form is filed annually, a few weeks after the annual report, in advance of the company's annual shareholder meeting. There are three things that I get out of the proxy form. There's a lot more in there. I'm not smart enough yet to know how to take it all out and use it, but three things that are pretty easy to find. One is how the management team is paid. What are their incentives? Are they easy or hard? How often do they reach their bonus objectives? What are the objectives? Are they focused on revenue growth? Are they focused on earnings growth? Are they focused on other initiatives? All these things can help give you a sense of where the strategy in the company should be going and will be heading, because that's how management teams are going to maximize their pay. It's all meant to line up. It hopefully is not a surprise because their strategy is consistent with what they say in other documents and filings and forums, but it's useful to know where the money is at the end of the day. You can also get the company's peer group, not just competitors, but other types of companies that it compares itself to. What universe does this company think of itself in? This is useful to get a sense of how the company sees itself in the broader environment, in the broader business world. If they're comparing themselves to huge companies when they're only a $1 or $2 billion company, that could be a yellow flag, for example. But it's more of a way for you to slake your interest in understanding how to put this company into context. The last thing that's of interest here is the major shareholders table that you will find in the proxy. This will show the stakes that the executives and directors, all the insiders, have in the company, how many shares they own, but then also any other major shareholders that own a certain percentage of shares in the company. Is there a founding family that still owns 50% plus of the voting shares, even though nobody in the family is running the company anymore? Is there a founder who is still in the company? How much do they own of the company's shares? Or is there a major hedge fund who has joined the board and owns 10% or more of the company? All of these things can be really interesting to understand who's ultimately calling the shots, where their incentives might lie over the longer term, where their strategy might lie over the longer term, and how likely changes are going to come. If there are huge shareholders, it's less likely that there are going to be changes because those shareholders are entrenched. These can all be valuable insights, not necessarily to take immediate action, but to further inform your thesis and your understanding of the company. There are a few other forms we'll cover in due time related to specific investment opportunities, but these forms are the ones that you need to track outside of the annual and quarterly reports. They're useful for informing your investment strategy and for informing your understanding of a company at the margins beyond what you're going to find in the 10Q and the 10K. That said, they still all come from the company itself. In my next video, I want to talk about sources you can use that are not from the company itself so you can get a wider perspective and a further understanding on a company before you decide whether to buy its stock. Subscribe to this channel to get that video. Stay tuned. It'll come out next week. Thank you for watching, and see you next time.